Hi, this is Paul Mampilly, and I wanted to make this video to try and answer some of the questions that I keep getting from customer service. Many of these questions come quite repetitively, and I thought just having this down in one video would be very useful. I would say that the most common question that we're getting is what you should do once a stock goes beyond its buy zone range, its buy zone price. And we've been telling you in our podcast for some time now that the buy zone is a guide. And the reason that we came up with the buy zone is because people were paying significantly higher prices for the stocks on the day that we're releasing our issues. And it was our way of trying to corral, if you will, put guardrails around the price and try to get you to use some price discipline in terms of buying. Now, it doesn't always work, and it does depend on the liquidity of the stock that we are telling you to buy. However, I do want to make this point clear. The buy zone is a guide. It's not set in stone. As I said during my presentation during the Total Wealth Symposium, it's not the 10 Commandments, it's not gravity, it's not a scientific fact. It is okay for you to pay a price that is above the buy zone. However, I do want you to understand that paying a price above the buy zone has two impacts for you. The first is that obviously you will have a price that may be significantly higher than the recorded price that you will see on our e-portfolio on our website. And second, we calculate our stop losses from the recorded price. The third thing I will say is that when the stock goes down, if you're someone that doesn't like seeing your stocks being in loss position for a period of time, it may make you feel bad. It may make you feel like you want to sell, even though we're continuing to cover it in our portfolio, even though it continues to be covered by us, it may make you want to sell the stock. And so these are the things to take into consideration. Another question that comes often to me is how to put together a position. Many of you, I feel, are buying your stocks all in one shot. And truthfully, I have to tell you that the pros, the professionals, never do that. The professionals always build a position up, and they might start with 100 shares on day one, and they might buy another 100 shares later that afternoon, and then they would buy another 100 shares maybe a couple of days later, looking at what the price action is, also getting more comfortable around the trading around the stock, and build their position out. If their final target is 500 shares, they would build it out over several days. If it's 1,000 shares, it might be over a week. And the benefit of this is that it gives you the ability to react to lower prices. So say you bought your first 100 shares on day one, and now the market's down on day two and the stock price has come down. Now you see it as an opportunity instead of feeling bad. You're like, hey, I can go in and get my second 100 shares. And by building your position, you're always in the position of where you can allocate a little bit more to the stock on the days when they're down. And by building it, you target an average price, and you'll feel more in control of your investing and of your stock buying. So those are the most common questions that I'm going to cover for this week. We'll have another video for you next week. Until next week, this is Paul Mampilly signing off.